mining sector, with some exceptions, is in dire straits. Lower global demand for commodities, particularly with concerns around the momentum of the Chinese economy, as well as lower prices, have made it difficult for mining houses to be profitable of late. In those instances where there is demand for certain commodities, some mining houses have still decided to cut down on production because of a lack of logistical capacity to carry their goods to port. A combination of these factors have seen volume declines.
They were then roughly 1.5% below the level at the same time last year. If we look at the general trend, then volumes are now roughly 10% below where they were prior to the pandemic, which has obvious consequences for employment in the sector.
Despite a steady supply of electricity since the beginning of the second quarter and some level of confidence that logistics woes at Transnet are beginning to turn around, the mining sector still struggled to grow volumes.
Of course, it will take some time before the sector can respond to any improvements in infrastructure, but unfortunately the sector is also confronting a number of other headwinds, such as uncertain and somewhat weak global demand and weaker prices.
Several mining houses have already implemented Section 189 retrenchment notices, citing lower commodity prices and the need to keep their businesses viable. A continuation in dwindling mining production volumes and commodity prices on the back of international and local dynamics could result in more pain for the sector. Nompumelelo Siziba, SABC News, Johannesburg.